All right, guys, let's hit it. If you guys aren't familiar with the S&P 500 Shiller PE Ratio, it's known as the cyclically adjusted price to earnings ratio. It's defined as the S&P 500's current price divided by the 10-year moving average with inflation adjusted earnings. So that's what makes the PE ratio very important, in my opinion. And it's got a lot of flaws, but at the same time, it's got a lot of good things going for it. It says here, it's used as a valuation metric to forecast future returns, where a higher PE ratio could reflect lower returns over the next couple of decades. Pretty easy stuff, right? It's nothing too major. But you ready for something? Let's go. 3, 2, 1, and let's ride. This good old thing here is currently sitting at 37.98. The highest it's ever been was December of 1999 when it reached a level of 44. Lowest it's ever been was in 1920 when it hit 4.78. This was its level on Black Tuesday in 1929 before the stock market crashed. It was about 30. This was on Black Monday back in the late 80s. Slight crash. We know this was the dot-com bubble over here. It was up at 45. 2008 market crash. We were right here at about 25, between 25 and 30, right on 27. And 2018, when the market crashed, we were at 32. And currently, the market, the current Shiller PE ratio is sitting at 39.17. And yeah, you should definitely expect some upward movement because the price earnings ratio is based on the average inflation adjusted earnings from the last 10 years. Okay, and I'll explain why this is super bullish for AMC and GameStop and not bullish for the rest of the economy. So it's a variation of the price to earnings, similar to PE, except CAPE ratio, also known as Shiller, is used to indicate whether a stock is undervalued or overvalued. And in this case, we're using it on the S&P 500. Pretty simple. So it's an assessment of the company's profitability over different periods of economic cycle. It considers economic fluctuations, economic expansion and recession, which we're all seeing right now, essentially provides a broader view of companies' profitability by smoothing out the cyclical effects of the economy. And it was derived by Robert Shiller, an American economist and a Nobel Prize laureate in economics. So this guy knows his stuff. This is price divided by the average earnings for 10 years adjusted for inflation. And an extremely high CAPE ratio means that a company's stock is substantially higher than the company's earnings would indicate and therefore is overvalued. It is generally expected that the market will eventually correct the company's stock price by pushing it down to its true value. So this is telling us that the CAPE ratio will go down to reflect the true price of the actual S&P 500, which is extremely overinflated, like we have never seen. Oh, sorry, I didn't mean to scroll up there. Like we have not seen since way back. The only time the Shiller PE ratio, CAPE PE ratio, whatever you want to call it, has been higher than it is right now was during the dot-com bubble back in the late 1990s, in 1999, 2000. What's up, Tell Dog, Brad, Jeremy, everybody? Thanks for coming out. JC, Kiwi. So anyways, we're going to go for a lot more of a ride than just that. That's pretty interesting information, though, I think, with the Shiller PE ratio. The CAPE ratio has proved its importance in identifying potential bubbles and market crashes, and it's been pretty consistent, as you can see. The higher it gets, the more likelihood of a market crash to precede it, okay? And this has been historic. So the record high levels occurred 3 times in the history of the U.S. financial markets. The first was in 1929 before the Wall Street crash that signaled the start of the Great Depression, which in my opinion is what we're going to see next. The Great Depression 2.0, unfortunately, with all the factors that are currently happening. These catalysts that are currently occurring, which will lead to the mother of all short squeezes soon. The second was in the late 1990s before the dot-com crash, and the third came in 2007 before the 2008 financial crisis. Low ratios indicate higher returns for investors over time. So seeing this high is terrible, and this is the highest it's been in a long, long time. And look at what happened from beginning of this year till now. It has increased significantly by about, 1/4. It has increased about 25%. Hello, everybody. Good morning. All right, let's go. My apologies. I got this from my guy Elmo. He did an absolute great job of bringing this to my attention because I completely forgot that this was even a thing. Because you don't hardly ever use it unless of times like this, you know, to gauge how strong or weak the economy is. And this is telling us that our economy is way overvalued, as is our stock market and the S&P. Literally, it's telling us the S&P 500. This is Elmo's due diligence right here. He said the CAPE ratio is proved. Sorry, it was the same thing that we just read on the other website. So this is a very smart individual here. I just wanted to give him a shout out. Please follow him on Twitter. You should definitely be, you know, aware of what's going on with this CAPE ratio. Okay. Yeah, it's Great Depression too. Electric Boogaloo, says Kiwi. Hell yeah. So this is definitely, you know, according to calculations from Barclays Bank, the average CAPE for 25 nation stock markets currently is 21.4, just over half of the S&P 500. It's 36.6. Do you see how overvalued it is when you compare it to the entire rest of the world right now? 25 developed nation stock markets is at 21.4. Let that sink in. But America is at 36.6. Sorry. That's an old, a few days ago, a few weeks ago, that's that article. America is at 39.17 on the Shiller PE ratio scale. Chart, whatever you want to call it. So, Market Watch had an opinion piece here, which I thought was pretty interesting, but it's a little old now, so that's why I updated it. And I'm going to let you guys watch this real quick.
We tend to use the Shiller ratio to look at
Here you go.
We tend to use the Shiller ratio to look at individual stock markets, and we're not alone in that. So
he's a very smart guy. Listen to this.
People use it to look at the S&P index, which is the biggest, most important index in the US. So right now, if you looked at the S&P, its current ordinary PE ratio is 16. So that says to me, well, you know, the US looks sort of not too cheap, but not too expensive. Not that bad. But let's look at the Shiller PE ratio for the S&P. Wow, 25, a lot higher. And now I'm thinking, crikey, the American market looks expensive.
This was in 2018. It was at 25 before the market crash.
I really be buying shares in America right now. Let's see, you know, how things have gone in other periods of history. I mean, the historical average is 16 for the Shiller PE, but probably its highest number ever was in March 2000, when the Shiller PE was 43.8. That was just before the whole dot-com crash. And actually, Robert Shiller at that moment published a book called Irrational Exuberance, and he said the stock market was way overvalued. My goodness, he was right. Back then, I was a young, naive investor, and I didn't believe him, but the numbers were telling the story. America was way overvalued. I wish I'd sold all my shares at that stage. And let's look at another interesting moment in history, early 2009, when we were in the whole middle of the whole credit crunch financial crash. The conventional PE ratio at that time was around 47. So that was saying the market was really expensive. But that seems counterintuitive because share prices were crashing. How could the PE ratio be high when share prices were crashing? Well, the reason was because earnings here was falling even faster than the share price. So seemingly the American market was expensive. It wasn't. If you look at the Shiller PE for 2009, it was more like 13, a real buy signal. The markets are cheap. It was time to buy. And thankfully, I did buy a few shares at that point. So as I say, it's most useful, this ratio, to look at individual markets, but you can look at it for companies.
All right, we'll leave that right there. But you guys get the idea. Shiller PE is extremely high, and the last time it's been this high was 2000.com bubble crash. And before that, it was Black Tuesday, right before the Great Depression. And we're going to see Great Depression 2.0. I'll explain why. Because we're going to the fucking moon. This is the most recent Federal Reserve Assets and Liabilities of Commercial Banks in the United States report, H8, released on September 3rd, Friday. Oh shit, run, says Ted. Yeah, brother. Casey, thank you very much. We're going to go over this puppy right here, right now. We're going to go straight down to table 2. There's 11 tables on this report. And this is expressed in billions of dollars. So when you see 15,788, that's billions, which equals $15 trillion, 788 billion. You want to look at their total assets? Check this out. I have not done this for this week. We're going to do it real easily. They started off in July of 2020 with 20.062 billion. Trillion. And then they're starting off with August 25th here. They're at 22.1 trillion. So that's an increase of $2 trillion on this asset, on the assets for this table in 1 year. $2 trillion. Understood? Assets, if you don't know what they are, that means things that are worth a positive value. In banking, deposits hold a negative value. The reason they're called a liability because the bank doesn't just leave them in the vault and your money's sitting there pretty. They actually take that and throw it in these shitty junk bonds and mortgage-backed securities, credit default swaps, and super senior synthetic collateralized debt obligations that they call SSS CDOs because they had to remake them and move these monies and these tranches around so many times that they had to literally add more letters to the acronym just to be able, every single time that they changed it and rolled these tranches around to get through the regulations that were passed recently and the SEC made with Dodd-Frank back in 2009, 2010. So we see that they've got an increase here of about $2 trillion in assets. Let's take a look at their total liabilities. That was 20.050, and they had 18.109 trillion, and that increased 1.940, $1,940,400,000. So in order to make the difference between this, they had to increase their liabilities by $1.94 trillion. So in order to make, and over here, in order to make $100 billion, these banks had to over leverage so hard that they increased their liabilities and their assets by $2 billion per year, just to make $100 billion. That's how low their returns are at the moment, and that's just on this one table out of 11. Then you got to look at their residual assets after liabilities, and that was actually 1952, 1.952 trillion back in July of 2020, and in August is 2 trillion, $53 billion. So it was barely a $100 billion increase, as you can see. However, none of these liabilities, these other liabilities, including trading liabilities, there's a lot of things that they do include and some things that they don't. They include subordinate notes, debentures, net deferred tax liabilities, interest, other expenses accrued and unpaid, accounts payable, liabilities for short positions, derivative contracts with a negative fair value, as determined by their shitty interpretation, other trading liabilities to which fair value accounting has been applied, which means in layman's terms, they don't know what it's actually worth. They're just estimating it's going to be worth this much and this is how much they're going to lose on it, quote unquote, and other liabilities, end quote. Basically, what does it not include? It does not include synthetic shares. It does not include failures to deliver that have not been reported, failures to deliver, and shorts that are marked as long positions. It does not include naked shorts. This is the congressional calendar for Congress You guys have seen this before if you follow me. Congress has been on vacation since July 30th was their last day working, and they don't come back to work until September 20th. They're fighting over the debt ceiling, spending, government spending, the infrastructure bill. FEMA has no money to cover the hurricanes that has passed through New Orleans all the way up to New York. It's nasty out there. And these banks have $189 trillion in liabilities, derivatives liabilities that are notional unrealized losses. And that is a quote, notional unrealized losses in derivatives liabilities. You can see the percentage here. The vast majority of it, about $110 trillion, is default, credit default swaps, total equity return swaps, collateralized debt obligations, mortgage-backed securities, 2008, Great Depression 2.0. Move on. Let's go. What's this? The Bureau of the Fiscal Service Daily Treasury Statement for the United States Treasury. Holy shit. What is going on, old Yeller? Janet Yellen, what the fuck are you up to? I can tell you what she's up to. She's not paying the goddamn bills. She's not paying Social Security. She's not paying Medicare. There's a lot of things that are not getting paid. Your doctors and hospitals and nurses are not getting paid. And they're not going to get paid probably for a year or so at this point. Maybe longer. Who knows what the fuck's going to happen. And they're going to get paid eventually, but it's going to get delayed a lot. A lot. Doctors and nurses are going to be working for free for a long time. At least the owners will. The nurses are still going to get paid because the doctors are going to have to. And if they can't, they're going to go bankrupt as well. Let's go straight down to healthcare marketplace payments. Zero. This table is expressed in millions of dollars year to date. Marketplace payments is payments to marketplace providers such as doctors, hospitals, urgent care clinics. It was $52 million this year, and as of this month, it was $0, and as of today, it was $0. See, fiscal year to date, this month to date, today. Medicare prescription drugs, they're on track. They had $97 million already spent. And hold on. Rounded in millions, may not add totals. This is absolute insanity. So Medicare prescription drugs have not been paid as of today. Actually, as of the 2nd, or no, the most recent one. Yeah, September 2nd. That's the most recent one available because that was Friday. That was Thursday. Friday's report comes out on Monday, and we'll go over that one as well. The difference here is they had 1.78 trillion at the beginning of the year, this fiscal year, and this month they started with 355. They had an influx of around $96 billion because the government got tax revenue and sold a shitload of junk bonds and mortgage-backed securities. The U.S. Treasury and the Federal Reserve, they sold it. Whichever one of them is the one that actually does the selling, but I know that that's what they did, and the money went to the U.S. Treasury. All right, so the Federal Reserve sold these junk bonds and these mortgage-backed securities to get an influx of $96 billion. But they spent how much in one day? Geez, that looks to be like they spent around $60 billion, a rough estimate, maybe $62 billion, just some off the top of my head math. That was only in a matter of a couple days. I meant to say, I apologize, from the 1st to the 2nd, because this is the report from the 2nd. So from the 1st to the 2nd, because this is a September report, they spent from 355 to 296. And on the 2nd, September, they started the day with 296, and they spent only about $4 billion. Thank God. So they have 292. This is rounded in millions. So this is $1 billion. There's $292 billion. I misspoke a little bit ago, and I know I did. I don't know why I didn't stop myself. But this table here is expressed in billions of dollars. All right. Rounded in millions. But this is 292,163 millions, which if you put that in a converter is 292 billion. Apologies, I just misspoke. You guys get my point. So we went from 355 billion in one day to 296. And then from the September 1st to this, on September 2nd, we closed the balance of 292. And we have not seen the report for Friday, September 3rd yet. We're going to see that on Monday. It's a big drop, $62 billion in one day and then $4 billion the next. You know, I mean, why would it be so little on the second day? That's because they spent the majority of the last day of August to balance the books. So they had to spend $62 billion. And as an emergency to prevent themselves from defaulting on their debt before, or trying to prevent from defaulting on their debt before these guys come back to work, as you can see, they're trying really hard by selling these garbage securities and whatnot. And even still, that's the only reason that they only had to spend $4 billion and change. And plus, they cut Medicare and Social Security. Emergency rental assistance, the eviction moratorium. Here you go, guys. They had paid $33 billion this year, and only $43 million were passed out. So still, we're at maybe 8 to 9% of the actual money that was promised to people for the eviction moratorium in emergency rental assistance has actually been distributed. Economic recovery programs. Do you see this? You see that negative number? That means they took $74 million from the economic recovery programs. The U.S. Treasury, the Federal Reserve, took $74 billion out of the economic recovery programs. Let that sink in. Captain Dammit says, my pharmacy didn't have my meds because ordering was delayed. You know, I didn't think about this till just now, but I went to go pick up a prescription from Walgreens yesterday, and wouldn't even be able to use the drive-thru. I had to walk inside and wait, and I still had to wait 20 minutes. I just didn't want to wait behind the 30 cars that were in the drive-thru at the Walgreens. I didn't think about that. I don't know, Nancy, if I'll stream during the MOASS. I will try. That'll be a lot of fun. I would love to stream with y'all during the MOASS. But anyway, that's old Yeller, Janet Yeller, doing her thing. But even still, on July 28th, they had a call to action alert to Americans regarding the rental assistance. And here we are today, not getting a goddamn thing for the economic. They're taking money out of the economic recovery programs, and they're hardly paying anything into their economic rental assistance today. They've hardly distributed a small percentage of what they promised Americans, and they added it to their GDP. They added it to the gross domestic product of the country. Here's a JP Morgan Chase. I tag these fuckers on Twitter all the time. I love it. Goldman Sachs, Citibank, Bank of America, Wells Fargo, State Street Bank and Trust. These are the assholes that hold those puts that have a whole bunch of puts and shares over in Luxembourg that we discussed in our last video in these ETFs. Look at their derivatives losses, unrealized losses, $52 trillion, $50 trillion, $46 trillion, $18 trillion, $10 trillion, $2.6 trillion. And their assets are $3.2 trillion, $288 billion, $1.6 trillion, $2.3 trillion, $1.7 trillion. Compared to $52 trillion, are you fucking kidding me? Add it up right here. Top 25 banks, $14.1 trillion in assets, and they're over leveraged to the tune of $187.9 trillion. This is my report. Okay. I know it says preview Reddit, but look, this report is directly from the Office of the Comptroller of the Currency. This is a notional amount of derivatives contract held for trading. Top 4 commercial banks. March 31st, 2021. This is the most recently available report. There it is, in case you had to think I'm on any bullshit. Sorry. June 28th, 2021 is the more recent report, but it's the same exact thing. It's just got slightly increased numbers as well. Okay, there you go. See how easy that is to find? There's the link. 52.6 trillion. 187.94 billion. It is the correct report for March 31st. So yeah, these fuckers are about to crash the stock market and the economy because they're over leveraged in these meme stocks, as they like to call them on the media, to try to discredit them. Fuck you, Citadel. Charles Schwab. They have adjusted their margin requirements. Charles Schwab is increasing margin requirements for all retail investors, or just anybody who invested through Charles Schwab, period, whether they're retail or corporate. AMC stock margin requirements is for long is up 100%, is at 100%, and at 200% for short positions. GameStop, 100% margin for long, 300% margin for short positions now. Options, long call, puts, and covered calls are permitted. They don't allow naked calls. Oh yeah, let's see. Naked calls if you have available funds for the increased requirements. This requirement. Naked calls is permitted if you have available funds for the new requirements. This requirement, 200%, 300% for AMC and GameStop. The price differential, in my opinion, is due to the price, the differential in the percentage differential here is due to the price differential in the stocks themselves currently. Please note, neither Charles Schwab and Company nor TD Ameritrade has halted clients from buying any stocks or selling any stocks they own, and neither firm has restricted executing any basic option strategies. Good for you. I like to hear that. Now, there's no date on this Schwab margin update, but I did a review of the HTML code here, and I did a date search, and the date that comes up for this, the posting of this new margin requirement update is September 20th, 2021. So this is a new, as of September 20, 2021, a new margin requirement for Charles Schwab, to the best of my knowledge. And this is the direct HTML elements for this table. Report. Interactive brokers, earlier this year, several months ago, a couple months ago actually, increased their margin requirements for securities in GameStop and other U.S. securities due to recent volatility, including 100% margin required for long positions and 300% margin on the short side. All right. Let's go, Ape Nation. Feel great, man. Cheers, everybody. We're going to be fucking rich. All right. Get your tinfoil hats on. Okay, this is about that time. This is tinfoil hat time. Take this with a grain of salt. Check this out. No, first, before I get there, no tinfoil hat here. Legitimate. Check out AMC Bigums on YouTube and Twitter. The man's fantastic. He gives a whole breakdown of the FINRA elimination of the OATS system. It's out. CATS is in. It's fantastic. Basically, no more synthetics. They're barely going to be able to create new short positions that are synthetic because they're going to have to be manually done, basically by hand, whereas previously they were being done by computer. So it's going to be very slow, and they're not able to do almost any at all, really. But I'm not going to get into that. AMC Bigham spends 12 minutes talking about this in depth. He does an amazing job of going over it. And he also, check out these FTDs to date increase. It's fantastic. Look at where we're at here as of August 12th. Wow, look at those failures to deliver, because they're aware of everything that has to come to play with these new Phase 5 requirements and regulations for the margin calls and the initial margin requirements for hedge funds and the initial margin requirements for banks being $1 trillion now, and for the hedge funds, $250,000 apiece, which is good because that goes for all their offshore shell holding companies. And we know that these fuckers have a lot of shell holding companies. How many? I'll show you. Well, I won't show you exactly how many, but let's show you their holding company revenue is up 200%. 200% for 2020. And they are more and more putting their money into credit default swaps and foreign exchange, who's rolling over contracts and short positions in credit default swaps, mortgage-backed securities, collateralized debt obligations. For holding companies is up 1,600%. For banks and credit default swaps are up 3,400%. That means that's 5,000% increase for banks this year because the banks own the holding companies. What else? Foreign exchange, futures contracts, and Forex. And the interest rate, like as bonds, they're completely in the garbage. Go over that, hit that real quick. Look at where our fucking reverse repurchase program is. I understand that the purpose of the program is to remove liquidity from the market by the Fed and allow them to burn up cash that's leaked out into the economy. And that's what the purpose of it is. But it becomes abused so heavily by these hedge funds, banks, and market makers, all these fuckers that are able to illegally stick their money into it, or legally, one way or the other, it doesn't matter how they're doing it, by using various repurchase agreements and buying these bonds directly from the government. This is the highest that it's ever been, and every time that it skyrockets, like it did in 2020, it's $237 billion. We have a market crash or market correction. Back in 2008, it happened repeatedly. They were hurting so bad, and so they were cycling through the money, trying to get rid of it. And back in 2013, This all began right here. There was nothing before this, but this all began here, September 23rd, 2013. And you guys want to know what happened September 23rd, 2013? Where'd that thing go? Oh man, we got to go back to it though. We got to go back to it. Bear with me. Come on, browser. Let's go. It's not cooperating. That's okay. We'll go like this. This is a long due diligence. This one was a long one. I apologize. It takes so long to get down to it. In October, let's see, a 2015 report from the Government Accountability Office analyzing the 2013 debt ceiling standoff found that investors reported taking the unprecedented action of systematically avoiding certain Treasury securities. So instead of putting their money in bonds, they immediately started putting their money in this reverse repurchase program because they knew that bonds were going to go negative and they needed this liquidity on hand as well. Come on. Excuse me 1 second. Oh, that sucks. This is how long it took Obama administration and lawmakers to come to an agreement, guys, from September 19th to October 9th. All right, and the effects on the stock market were ridiculous. They were ridiculous. Okay. The United States reached the debt ceiling of $16.39 trillion that had been enacted following the debt ceiling crisis of 2011, which was also a market crash event in which global equities lost $2.5 trillion in one fucking day. So we were downgraded, and potentially we could have been downgraded from AAA as well. You know, that's pretty bad. Basically A-. And the only way that they got through it here was Obama. Well, excuse me, I kind of misspoke there. But Obama signed into law suspending the debt ceiling through then, even though Republicans were voting no. So he had a way around it, which currently Biden does not have. So it was reinstated again, and in August the 26th, the Treasury informed Congress that if the debt ceiling was not raised in time, the United States would be forced to default on its debt sometime in mid-October. Janet Yellen already told us that we could default on our debt before or after Congress comes back on September 20th, 2021. And now with COVID and FEMA spending, there's hundreds of billions of dollars in hurricane relief. They're going to need more money than ever. Story time. Last week, my logistics company didn't deal with any FEMA loads. This week, we handled 13 FEMA loads. Just my company. And we don't handle FEMA. We haven't handled a FEMA load in a year. Okay? That's just an example. On September 25th, Treasury announced that extraordinary measures would be exhausted no later than October 17th, leaving Treasury with about $30 billion in cash plus incoming revenue and no ability to borrow money. It's the same thing that's happening right fucking now. Same thing. And look at what we look like now compared to how we did back then. September 23rd, September 27th, they started abusing it, and it just got worse and worse. And these derivatives liabilities have been getting worse for so long that this is what 2008 looked like with the credit default swaps and mortgage-backed securities, and this is what 2021 looks like. This is why Netflix is no longer making episodes of Black Mirror, because the shit that happens in real life, it can't even be eclipsed by a fucking TV show. Here you go. Negative outlook. A minus, and the amount of money that we lost too on the stock markets. Lost about 7%, you know, on the S&P in a matter of a day or two. 5.4% on the SPY. The Treasury's fucked. Economic recovery programs, they're taking $74 billion out of to maintain afloat. I showed you that Medicare prescription drugs have not been paid as of today. Marketplace payments haven't been paid as of September 1st. Railroad Retirement Board, they don't have anything in there, excuse me. That's not much. Total Federal Reserve account, $175 billion there. Total withdrawals, $175 billion. They spent $63 billion that day. Wow. So now you see how fast they're going broke. They only spent $4 billion that day because they spent $63 billion the day prior to balance the books on the end of the month, August 31st. September 1st, excuse me. Let's move on. So we've got Charles Schwab as of September 20th increased their margin requirements for retail. Interactive Brokers did earlier this year, and we have now got the new CAT system, and the FTDs are increasing like crazy again, just like we saw back in June and January, and it's going to get worse and worse because they're not be able to make new synthetics. Yeah. Cheers, everybody. I hope you're happy. I really do. This is the most bullish shit I've ever been able to say. Put on your tinfoil hats. As of September 4th, the New York Post put up an article saying that the former FBI agent says 9/11 hijackers had U.S.-based support. I don't know if this is true or not, but this is something that has to be discussed real quick because this guy is a former FBI, and he's saying that new records signed via executive order by President Biden on Friday directing the Department of Justice to oversee a declassification review of documents related to 9/11 after pressure of families of victims, etc. The Department of Justice must release any declassified documents in the next 6 months. And so this is some records pertaining to Operation Encore are what this guy Gonzalez said that two hijackers, I won't say their names, were helped by a number of Saudis, including Omar al-Bayoumi, people in the United States. So I can't say as to the validity of this claim, but that's what a former FBI agent is saying on the New York Post as of September 4th, 2021. Keep your tinfoil hats on. Salomon Brothers, the SEC, the Department of Defense, and the CIA, as well as American Express, all owned floors of World Trade Center 7 that collapsed mysteriously on September 11th. Well, it seems to be mysterious in the sense that the way that the building fell was very not natural looking to many people. And there are records of renovations being completed in the late 80s and early 90s by Salomon and the SEC, removing entire floors and adding weight to certain floors and diesel generators. Salomon Brothers created the first mortgage-backed security. Salomon Brothers has close ties to the Federal Reserve Bank in New York. Salomon Brothers and Travelers Group, Smith and Barney, who were purchased by Citigroup, the assholes who own the BDRs in Brazil, who became Citigroup Global Markets, who entered into a joint venture with Morgan Stanley, and then both dropped the Salomon name to remove themselves from that reputation. This is a video by Charlie's Vids. Salomon Brothers has always been. Posted August 29th, 2021. It's a fantastic video. Go follow this guy immediately. Salomon Brothers, at the time of September 11th, 2011 attacks, Salomon Smith Barney was by far the largest tenant in the 7 World Trade Center, occupying 1.2 million square feet. 64% of the fucking building, floors 28 through 45. Fuck, that's messed up. Could it possibly be that Citibank needed a way to clear the books from Salomon Brothers? Who knows? Who knows how if they needed to get rid of those financial records and everything else that was in that building and it belonged to the SEC, and they have records of installing diesel generators and shit. And I don't know, guys. Keep your tinfoil hats on, but that's some interesting shit if you ask me. You know, so we can move on off this subject if you guys want, but Salomon had a lot of losses. Citigroup was buying them out at the time, and conveniently, hundreds of millions of important legal records were destroyed in this building that collapsed ever so perfectly. Rest in peace. This last tinfoil hat part doesn't really have so much to do with, the mother of all short squeezes. It's just an illustration of something that I wanted to show you guys because I think that it's very important. But if anybody has any questions, I think that we've had enough here with this 45 minutes of chat. It's been a great one. If anybody has any questions about mother of all short squeezes, I've had a lot of interesting questions. I've been getting asked things about price ranges and price targets and all sorts of things like that. I do think that the United States is going to come very close to defaulting on their debt before Congress agrees on a debt ceiling infrastructure bill agreement and passes it. I do think they're going to default, but even if they don't default, the stock market and the stock market is still going to see a massive correction, in my opinion, a massive crash like we haven't seen since 2008, maybe since the Great Depression, because we are over leveraged to the tune of $190 trillion. That does not include shorts marked as long, synthetic shares, FTDs, or naked shorts. That's heavy. So the mother of all short squeezes, in my opinion, is going strong here. And when they have to buy back these shares, it's going to when they lose their assets, lose liquidity, as we get close to the debt ceiling issue with Congress getting tighter and tighter towards October 1st, government shutdown with no debt ceiling increase in place, we're going to see massive, massive market corrections that's going to drain liquidity from these market makers, banks, and hedge funds. It's going to cause margin calls left and right, a domino effect that's going to make them lose a lot of money. They're going to sell a lot of funds, a lot of assets out and keep cash on hand. Meanwhile, the market crashes. Many millions of Americans and people nationwide that are invested in the American stock exchanges are going to lose their life savings, pensions, 401ks, and God knows what else. When this happens, these margin calls are going to cause these overly leveraged short positions to be closed out. All shorts must cover and close out entirely at some point or another, especially when a market crash happens and margin calls get shot out. Now with the new CAT system, they're not able to make new synthetics. Now with the new Phase 5 regulations, they're not able to just sweep everything under the rug and push it around anymore. They're not going to have enough money, and they're going to have 1 hour to meet their margin call requirements from the SEC and the DTCC. And those prices are going through the roof, through the fucking moon. It's crazy. So yeah, the blue chip stocks and bonds are going to go down. In my opinion, the 3-month Treasury is going to go negative. 3-month Treasury returns are going to go negative. And stocks blue chips are going to get crashed down at levels they've not seen in a long time. And overly leveraged meme stocks that the media is trying to diminish because of how much money all these companies are going to lose, which own the media, mainstream media. We're going to see the most beautiful price action we've ever seen in our lives. So that's my theory as to what I think is going to happen here with the market crash, the market correction. As far as AMC and GameStop price targets, this is not my financial advice. Nothing that I said is financial advice or, advice in what you should do with your money in any way or your life. It's just information that I've come across that I thought was important to share with you. Do your own due diligence. But I do believe from everything that I've seen on synthetic shares that I do believe that 5 to 10 billion AMC synthetic shares is going to be revealed, if not more. I wouldn't be surprised if it was double that amount easily. And the same thing goes for GameStop. I wouldn't be surprised if 10 to 15, maybe 20 billion shares of GameStop come up. Synthetic shares over the float. I know the float for GameStop's under 80 million. I know the float for AMC is 513 million and change. But I still think that AMC has around 10 billion synthetics within, very well within my reasoning from what I've seen through these ETFs, these exchange traded funds, through these BDRs, the Brazilian depository receipts, through the shares here in America, through the puts on the Bloomberg terminals. Okay. We're going to hit this Bloomberg terminal real quick. You guys might have seen this. This is going to be where I'm going to finish the video here, though. BTG Pactual Asset Management. Capitalo Investimentos, Constancia Investimentos. See these positions? These are all puts. So every one of these is actually times 100. So these are puts representative of 100 shares. I'm saying, yeah, of 100 shares apiece. All right, and we've got 720,000 there, 397,000, right, 900 right there in these ETFs that were stashed away on the Bloomberg terminal. And that's 1.140 just when you add these up. But now you have to multiply that by 100. So in reality right there, how many puts do they have? 114 million. Right there, just between those three companies. And a lot of them are holding them on these a lot of them are holding them as these BDRs. And like for example, iShares MSCI Brazil ETF, EWZ. Their holdings are B3, Banco do Brasil, Petróleo Brasileiro. Check this out. You guys ever heard of Operation Car Wash? Tinfoil hats on. Petrobras and the senator, people for the Petrobras senator and BTG Pactual were involved in this scheme. The CEO went to prison. Petrobras former CEO Aldemir Bendin was convicted on corruption charges, but annulled by the Supreme Federal Court in 2019 due to objections to the trial procedure. Can you say corruption? Ever heard of Odebrecht? Same thing, involved with Petrobras. Odebrecht has become shorthand for unprecedented regional bribery scandal. Between 01 and 16, Odebrecht paid $788 million in bribes across Latin America. All right. Brazilian authorities arrested the former CEO in connection with probes to oil giant Petrobras. He's there in all B3, the depository bank, the institutional bank of these BDRs in Brazil, as well as Petrobras, are involved in all of these ETFs, every single MSCI. What a bunch of crooks. I got to get to BTG. Jesus Christ. André Esteves is a Brazilian billionaire businessman. He is ranked the 6th in the world with a net worth of $21 billion almost, according to Forbes magazine. He currently serves as a senior partner at BTG Pactual, the biggest investment bank in Latin America. What do you guys think? In April 2012, André Esteves was fined $350,000 for insider trading in Italy. Officials also froze 4.2 million euros of Mr. Esteves' personal assets and barred him from acting as an officer in an Italian company for 6 months. Insider trading, huh? In 2012, penalties for his insider trading forced the bank to amend its prospectus, give investors the option to reconsider bids for BTG shares. And then, in a statement, BTG Pactual said Esteves believed the allegations had no merit and was determined to appeal the decision. However, he did not appeal because he knew he was going to fucking lose, and he blamed it supposedly on costs. Yeah, okay. In 2013, Charles Rossier, a partner of BTG Pactual, was convicted in the largest insider trading case in France. Look at these. These are the class acts that work at BTG Pactual. Do you think that this is fucking fake? That this $25,000 a year Bloomberg terminal is showing us an error that they have 22.1 thousand puts on GameStop? I don't fucking think so. These guys are fucking crooks. They've been to jail. They're felons. So this asshole has already gotten in trouble with Italy for insider trading. And this asshole was convicted of the largest insider trading case in the history of France. And this asshole had the largest insider trading case in Italy. What the fuck do you think's going on in Brazil? You think CFTC, Commodities Futures Trading Commissions, was just able to do this shit through Rostin Beanham, the newly appointed by fucking Biden, while the other asshole that used to work there is now working at Citadel? Fuck you guys. I think his name's Heath Tarbert. Fuck you, Heath Tarbert. You're an asshole. You too, Rostin Beanham. And Gary Gensler, I want my fucking money. My whistleblower money, if anybody's wondering. I forgot there's other people watching. I feel like I'm yelling at Gary Gensler because I know these fucks are fucking watching these crazy videos. I don't give a shit. They know what's real. Look at the conflict with Brazilian regulators and the central bank. Bloomberg reported that in 3 cases since '99, Brazil's central bank and Securities Commission alleged Pactual had illegally transferred profits to foreign funds to disguise gains and avoid taxes. These fucking felons. As such, Esteves and his partners received warnings. They got slaps. They got fucking slap on the wrist. I will give you a fucking warning for your billions of dollars in profits and tax evasion. Fucking crooks. Furthermore, in the third, he and another partner were ordered to pay a combined settlement of 100,000 reals, with Pactual paying another 4 million reals. Remember that guy Odebrecht? On June 2015, the CEO of Brazil's largest construction company was arrested by federal police on allegations of fraud, corruption, money laundering, organized crime, and contracts related to billions of dollars with Petrobras. Petrobras, right? You guys remembering this? The guys that are right here inside all of these fucking ETFs and all these MSCIs in Brazil and around the world, including Luxembourg and DTC, in France, in London, everywhere. Cayman Islands. While in a detention, look at this. While in detention, Odebrecht attempted to pass a handwritten note to his lawyers that mentioned Andre Esteves personally, thus potentially implicating him and Esteves in Lava Jato. It's a Operation Car Wash. All right? Odebrecht, this fucking crook, the CEO of Brazil's largest construction company, was arrested by the Brazilian police, the Federales, and he was arrested on allegations of fraud, corruption, money laundering, and organized crime relating to contracts worth billions of dollars with the rigs company Cita Brazil and oil company Petrobras. These guys are all crooks, and Odebrecht sent a fucking handwritten note. He attempted to pass it to his attorneys, mentioning Andre Esteves. You gonna tell me these are fake? Yeah, right. Gary Gensler has entered the chat. Hello, Mr. Gensler. It's nice to meet you. My name's Boss Blunts, Marcel Klinovic. Cheers. Damn, we're going to be rich as fuck. And what happened over here? Development Bank, BNDES, the National Bank for Economic and Social Development, withheld funds from Petrobras, from these guys in Petrobras and this rig company, and that he accepted bribes in exchange for awarding contracts as part of a wider corruption probe in Operation Car Wash. So it just goes on and on. And 3 weeks after he was arrested and convicted, Esteves was released from prison. All right. On November 2015, Esteves was arrested as part of a scandal investigation into Petrobras after he was investigated for his bank's dealings with the oil company. Okay. It was reported that Brazil decided to extend his arrest. And according to the same report, BTG Pactual's partners were in talks to buy 22 to 24% of his stake, including a golden share. And 3 weeks later, he was released. BTG's bonds and shares subsequently increased. What do you think they did with this money? What do you think they did with this 22 to 24% stake for him to be released 3 weeks later? Tinfoil hat, huh? Wow, we must be really fucking stupid. And all these MSCIs, I could show you 53 of them, but I don't even know where it is right now. I have to pull it up, and I don't want to waste your guys' time, okay? So that's where we're at. I think we're all going to be filthy fucking rich, and a lot of these assholes are going to go to jail. So thanks a lot, Ape Nation. Cheers. Have a great weekend and a beautiful week. It's going to be a nice one. It's going to be a fun time, and the mother of all short squeezes is fucking upon us. Rest in peace. The American dream. The housing market is fucked. Invest in real estate post MOASS is what I'm going to do, as well as some other precious metals and possibly crypto. Not financial advice. That's just what my plan is. Not to mention business, because I didn't give myself the name Boss Blunts. So, peace out, Abe Nation. Thanks, everybody. Jeff Norman asks, any chance Facebook or Google goes broke in the impending crash? Not a fucking chance. Google and Facebook have so much money, they're not going anywhere. Healthy ass poor, yeah, healthy ass poor is in order. JM says, I don't want a Lambo. I want to own Lambo. That's what I'm talking about, man. That's what I'd like to see. You know, I'll buy SpaceX from Elon. That's cool. I want to meet Elon anyway. What better way than to buy one of his companies? So yeah, we're going to have a fun time, you guys. We hit the 1 hour mark. It's been a fucking awesome video. I can't believe it took me an hour to get here. I apologize. All my videos are so goddamn long. I could talk to you guys for another 10 hours about this literally right now and just go through corruption after corruption and more hidden shares and things like that and other due diligence that is related to the stock market that's not anything about hidden shares, like the RRP and Bloomberg terminals and charts and technical analysis. But there's a lot of people that are already discussing that. So I think that I'll leave it to them because they're probably better at it than I am. And I'll just say, we're going to the goddamn moon. This is fucking wonderful. I feel sorry for what's going to happen to the 99.7% of Americans that are not invested in AMC and GameStop. But we can only try so hard to inform people of what's going on, and what they choose to do with that information is their own. God bless everybody, and peace and love. To the moon. And fuck Citadel. Fuck Rostin Beanham. And fuck all these assholes. Kenny Griffin. And Charles Gasparino, that little bitch. And Rich Greenfield. Fuck you too.